As much as 9% now, down maybe 1% or fractionally after beating on earnings but missing Wall Street's guidance expectations and announcing the CFO is departing. TakeTwo Interactive also reporting moments ago, reporting a loss of $1.52 per share, missing on revenues. It was lower. Now it's higher by about 3%. Joining us now is LightShed Partners media and technology analyst Brandon Ross. Brandon, what's happening across these portfolios that investors should zero in on? At the high end, there's console. At the lower end, there's apps with in-app purchase and advertising and those kinds of dynamics. And we've seen some strength in the likes of AppLovin, which deals in that ecosystem.
Yeah, so let's just level set here. The games industry right now is not a growth business. I was listening to WBD's call yesterday, and David Zaslav pointed out that they own, obviously, the War Game Studio, and how that was, a bright spot of growth, an industry that's actually growing. This is an industry that's basically been flat since COVID. And so what you're seeing is market share kind of shifting around between players all over the ecosystem. In the case of ad tech, AppLovin is killing Unity. It's that simple. I think that Unity had a lot of missteps over time, and AppLovin just continues to really innovate and has figured out that you need to utilize data. Unity never utilized the assets that they had, having 70% market share on the build side of their business. So you're seeing, winner and loser there. In terms of console games and time spent, the way we've looked at investing in these companies now is where time spent is moving, that's where you want to invest. And so in the quarter, you saw EA come out and they had NCAA football, and that took some oxygen out of the room for some of the other console players in a generally down console market.
Brandon,
one of those may have been 2K.
Okay. Now, explain to me, though, what the long play is, because I'm old enough to remember just a couple years back, we had the big tech players across Amazon, Google, and Microsoft all talking about cloud gaming, streaming. Microsoft actually bought Activision Blizzard. There must be a longer play in this than just a slow growth, no growth industry. Where's the strategic value here that investors should be thinking about as these stocks, this industry in general, goes through a rough patch?
Look, I think that your 3D Interactive will, over time, return to a growth business as there's better interactive experiences that are available to a broader swath. So you brought up cloud gaming there. That should help unlock both, sort of the proliferation of console type gaming and also new formats. But that is a little further away than all of us had hoped, especially Microsoft. And you've seen Microsoft backpedal in cutting jobs, et cetera, since they made the Activision acquisition. Subscription hasn't played out the way they hoped. Streaming hasn't played out the way they hoped, and that's further away. In the meantime, you want to own companies like Take-Two, who has GTA 6 coming out and is probably going to take a significant amount of playtime away from everybody else when that game comes out and they move into a new version of GTA Online.
So, Brandon, are we talking about companies that are acquisitive here then in the meantime, especially if there's so much onus on the pipeline?
I don't think you're going to see the type of consolidation that you saw the last couple of years, to be honest with you. And the reason is a lot of that acquisition activity simply didn't work out. Again, like the Microsoft Activision deal, TBD, but so far doesn't seem so good. Right? You saw Sony acquired Bungie, and you saw, this week that they're cutting 17% of Bungie jobs. So I don't know if we're in the stage right now where you're going to see a ton of acquisition activity. Over time, does it make sense for a Take-Two and an EA, DOJ willing to potentially get together? yeah, that would be the dream. But
Okay.
I don't see anything in the near term.